What is up, ladies and gentlemen, boys and girls, members of the UMortgage market update viewership? Welcome to another Monday morning with myself, Sean Grapevine, director of Agent Direct and longtime host of the Monday Mortgage Market Update here at UMortgage. Thank you so much for being with us here this morning. And thank you so much to my co-host for being with us here this morning. He's not unlike a Formula One race in which Max Verstappen starts. He's oh Jesus, I messed this up. Oh man. All right. He's really good. He's good. He's a good guy. I was just gonna say all sorts of great things about him. They were gonna rhyme. There's gonna be some alliteration. There was gonna be metaphors. There's gonna be similes. There's gonna be rising and declining of my vocal patterns. I was gonna invite you guys into it. Was gonna get you guys excited to be with the one, the only, the awesome Austin Koenig. Welcome, Austin.
Thank you, Sean. Thank you as always. We'll we'll just power through that and just pretend
Yeah,
like it didn't
we'll
happen.
fi-
Let's
we'll fix
let's
it in
do it.
post. Caden, can you can fix that in post, right? Thank you so much. He's confirmed that he can.
There we go.
All right. Well, welcome, Austin. I guess that gives us a lot more time, or maybe we can actually give some time back to these folks and end this earlier than 10:20 for once in our lives. How was your weekend?
It was good. It was good, and I guess a lot's happened since we last talked. The Fed has met. The Fed funds rate is 25 bips higher than when we last spoke
Mhm.
with our wonderful audience. So I guess there's a good amount to recap, and you know what? We can have things to look forward to this week. And
Yeah,
we have
definitely. And I,
yeah.
I think I think a lot of what happened last week just goes further to show what I've been saying since about a year ago, that the soft landing is in. You guys don't have to worry about it anymore. Just just go on about your day. Soft landing is in. This is the new normal. It's a good normal, and we did it without breaking the unemployment rate, or the employment situation of too many Americans. But before we get to that, let's talk about the Fed funds rate. Kind of as expected, right? 25 bips up. Not much of a reaction in mortgage bonds, or any fixed income to speak of. We saw a slight strengthening in price for a little bit, and then we saw a decline in price. Just kind of typical day of swings. Is that about right?
Yeah, and I would say all things considered, we had what happened very priced in, and there was no surprise, and the Fed, stuck to the script necessarily. During the press conference, Jerome Powell, very much mentioned clearly, hey, like data is what's going to be driving, future decisions. There's no, yes, there's a hike next time we meet. It's more so the data is going to have to make that happen. So at the end of the day, we saw data last week that pointed to a lot of what we talked about, and the same thing what you said about the soft landing. A great Q2 for economic growth, really beat expectations. That's what kind of really drove up rates, and price worsening on Thursday. But we've continued to see PCE and the CPI both sing the same song. Inflation is
Yeah.
cooling down.
Let's talk about PCE for a second. I mean, PCE is down, from the high threes, which is already, a significant improvement, down to, I think, right at exactly
Yep.
3%, right? And then core PCE is remains in the maybe the low fours. Is that right?
Yeah, so exactly, and we saw the PC mimic very similar to CPI and core CPI. At the end of the day, it is very much like in the right track. It's going the right track. We just got to see it continually go that way. And what this week kind of helps highlight on the data side is the labor market, and that's what the job market, labor strength, the strength of consumer that really helped drive Q2, is driven a lot by the labor market in that sense. So the Fed's going to be continually monitoring that. And if we see really strong labor numbers this week, which we literally have, except for today, every day we have some sort of labor market data point.
Oh
So
yeah. Okay. So yeah, go through some of those. So what do we expect to see Tuesday through Friday?
So Tuesday, it's all about job openings. JOLTS is the metric there, and that's going to come out Tuesday morning around 10 a.m. It's not the best timing for rate sheets, especially if you get a surprise. But then we have Wednesday, which is ADP. So that's kind of like our precursor job number. I wouldn't say it's as important as Fridays, which is the BLS typical non-farm payrolls job report. That's the big one. That's the headline banner. And then Thursday we have of course initial jobless claims, which we get every week, of course. But hey, like we've seen that move the market, in the past weeks, months. So we have to pay attention to it still. So at the end of the day, those are 4 days, in the next 4 days, where we have something in the morning to digest, and the market to digest, and how they price in another hike or no hike or whatever the case is. They have a lot of data to digest this week.
Wow. Well, Agent Direct is really doing its part in keeping the unemployment numbers as low as possible. We're sending out offer letters faster than our printer can print them off. So we're doing our part, and I know you mortgage in general is, as well as our ranks swell. So Friday's kind of the headline number, and this is going to give us that how many jobs, like what it measures. It gives us an updated unemployment rate, but by via the job creation numbers, essentially, right? What's the actual like headline metric?
Yeah, so unemployment rate, and the thing is like you can create jobs, but that isn't necessarily going to be exactly what unemployment rate shows, because at the end of the day, people can fall out of the labor market,
Mhm.
people can re-enter the labor market, and that can fluctuate unemployment rate without any jobs created or lost, right? So that's kind of like an underlying mover that can happen. But regardless, though, yeah, like people get laid off, jobs just completely dissolve. Yeah, that can make unemployment go up as well. Non-farm payrolls is really strictly at jobs added, and unemployment rate is kind of like a combination of different factors. And is it the super most accurate thing to read? Not necessarily, but it's a thing that the Fed wants to keep in a certain range, and it's an easy thing to quote because it's the same, you know, same way it's been calculated for a while now, right? Like
Mhm, mhm.
we want to. I think the general like macroeconomic like benchmark you always want to point to is like 5% or lower unemployment. 5% is a typical economy. We're running well below that in the mid to high threes, depending on the month. So, our labor market's strong. It's just a matter of if it weakens a little bit, we can still be in a healthy unemployment rate. That's what the Fed's kind of saying. They're like, "Well, look, we can get 5%. We're still okay. We'd like to keep it, even probably below that, but we don't want to see it heat up to, unemployment rate at 3%, and jobs are just coming online, labor's in really tight demand, wages
Right.
go up. That's what we don't
Because
want to see."
yeah, yeah, because they worry that this will create an inflationary spiral. So as morbid as it is, I kind of get it. You think there's got to be a better way, but I guess most people get their money from their jobs, believe it or not. So that's I guess is all stands to reason. So we've got a bunch of labor numbers coming out this week. When's our next CPI print?
So that's going to be not. I need to double check that, but I think it's going to be the 10th of August. So it's
Okay,
not
so we
this
got a
Thursday,
little bit
but
of time.
next.
Mhm.
Yeah.
And that'll be one of the major milestones for where we're at. Whether we continue the sort of precipitous decline uh, in uh, in inflation, whether we've actually seen one of our first reductions in prices month over month could be on the table, or whether it was all just a flash in the pan. We're still dealing with some endemic inflation. So, as a loan officer, and for you as somebody in capital markets, what should be my outlook for the next quarter to 2 quarters, rate wise, market wise in general?
That's a great question, and I would say generally, I think it's the rest of the year. Really, don't expect any sort of Fed rate cuts or anything like that. I think we're going to be in this range for a little while. The economy's kind of humming along. And when you listen to how the Fed speaks about this, it's kind of like a continually restrictive policy, but that doesn't mean rate hikes forever. That just
Mm,
means like, hey, we have to keep this Fed funds rate that's higher than what everyone's used to post economic crisis of 2008. This is kind of a little bit higher and elevated, but it's clear that the economy can kind of hum along, grow, and as long as we see that economy still be resilient and able to grow, but not at an uncontrolled level where it's way too hot, this is where the Fed feels comfortable leaving the Fed funds rate at. Sure, they might reduce it a little bit, but one thing that Jerome Powell did point out is we can have a rate cut, but still be in quantitative tightening policy. So what that really means is we're not going to be buying bonds and sending just tons of cash through that kind of exercise, right? We might rate cut a little bit, but we still feel like we need to have a restrictive policy to an extent. And that's just where we're going to be. So, sure, the rates right now where we're at, it's probably going to be fairly similar. I don't think it's, worth gambling too much. I don't really see, too many like rate swings, for the worse. The only thing that I think that could really happen is it goes worse before it goes way better. And that's only just because of really hot economic data that we haven't seen necessarily on the inflation side recently. Hopefully we don't. But the labor market side can get a little hot. That's a little bit of something that's still a little bit unpredictable, necessarily. So we'll see. I mean, I feel like the economy's kind of hit a little bit of a stride to keep it semi growth oriented, even with the restrictive policy. So
sure. I mean,
how much job?
2.4% on GDP for what 21st century United States is pretty pretty good, especially considering what we've been through and the fact that it's on the heels of a couple quarters of reduction in GDP. So yeah, certainly, I mean, certainly a good sign. And I think it's like good to keep in mind that we should be kind of thankful that the economy can handle higher rates because it's those higher rates that are the only, as we've talked about before, the only arrows in the quiver. I mean, besides other quantitative easing policies that you can put into place when it comes time for like the next major economic meltdown, right? The next recession, the next like global financial crisis. Reductions in rate, the higher you are to start, the more effect it's going to have. And it's one of the reasons that it was so difficult in 2020 and 2021, or with COVID, was like, what was our Fed funds rate going into that? Right, it was two, something like that. That we didn't have any.
Hmm.
There's no room to maneuver. So anyway, I think the lesson here is we're finally starting to hit some stability, and that's great for loan officers, right? It actually doesn't matter what the rates are. It matters that people aren't getting spooked by them. It matters that when they look back, a little bit in time, they're not saying, well, they're 7.5 now, and 3 months ago they were 4.5, which is what we were going through in September of last year. Now they look back, they're 7.5 now, and 3 months ago they were 7.5, right? Like that people could become used to the new normal relatively quickly, but not instantaneously. So we're seeing clients that like they just got to buy houses, so that they don't really care what the rates used to be. They care about what our rates are relative to everybody else's, which is cheaper. Um, so speaking of some capital market stuff, any exciting news on you guys? And any products or lenders that are being brought online anytime soon?
Yeah, we actually have a lot of things in the works behind the scenes. I would say we probably have like 4 or 5 lenders behind the scenes that we're working with, bring online. There's a couple that are, just in the ride. We talked about that we're going to get signed up with here shortly. If it's already not in front of them, just a matter of getting the approval and trainings done. But there's a couple other lenders. In terms of the non-QM side, there's a couple specialty products that we're going to try to work on for those loan officers that have different types of clientele. Just kind of fill in some gaps, some unique lenders that only fill one space. So those will be coming online. I don't know if I really want to touch too much on that one, but I think another lender that's supposed to be coming online with Arrive in the next 30 or so days. We have a great AE over there. We just are about to start doing a package for them, and these are lenders that also have VA down to like 550, FHA down to 550. It was filling all buckets because at the end of the day, it's a purchase market with a lot of different people that want to
What
buy houses, like you said.
a Ben
So
Bell special is what I'm hearing. Ben,
a bet.
I know you're probably not watching this, but just kind of throw that jab in there. So okay, Ben will get super excited about that.
Yeah, and I don't want to put the cart, before the horse here, but we'll be obviously announcing it to you guys as we get them approved and everyone trained up on them. But some of these are going to be more specialty, but there's probably about 2 or 3 that are going to be more. Everyone's using them. They're in Arrive, and it's a new ability for us to have a great partner that can support our business in a very systematic way. So we're
Love
excited.
it, love it, love it. Competition and integration are great for our lenders. So, well, you guys heard it here first. We had 25 bips rate hike last week. Didn't really move the needle. GDP up 2.4%. PCE down to 3%. This week we've got jobs, 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 and then more jobs. Hopefully we didn't create too many or get rid of too many. It's impossible to know what to hope for. But the lesson here is we have attained some level of stability, and it looks like we might be able to stick around there going forward. So if you like it, lock it, and let's all go get some loans. Thanks for hopping on today, Austin.
Of course, thank you as always. Have a great week, everyone.
See you guys.